Today is June 7th, 2014, and this is episode 116. This program is intended for informational and educational purposes only. Cryptocurrency is a new field of study. Consult your local futurist, lawyer, and investment advisor before making any decisions whatsoever for yourself. Welcome to Let's Talk Bitcoin, a twice-weekly show about the ideas, people, and projects building the digital economy and the future of money. My name is Adam B. Levine, and today we've got a treat. Tim Swanson is a researcher, observer, author, futurist, and skeptic. Today, Stephanie Murphy and I sit in, but this show is about the world according to Tim. Let's get started.
Hi guys, it's great to be here. My name is Tim Swanson again, and I wrote a book called Great Chain of Numbers, thanks to the community. And throughout this podcast, I'm sure I'll have some criticism of certain aspects of the space, but I'd like the listeners to know that I really think this technology is great. It's world changing, and despite my criticism, I think the world of these people, and I don't want this criticism or skepticism I have to reflect on the people that I've quoted in the past. Their opinions are completely not shared with mine. They would disagree, but just wanted to say that up front. I've been discussing this issue with Jonathan Levine at Coinometrics and Robert Sams, who is at Cryptonomic. He's the founder of, like I said, Cryptonomic, and Cryptonomics is a website he has. And he was a interest rate hedge fund trader for about 11 years. And the issue is this: does the Bitcoin network proportionally reward the proof of work that is going into, like, every second or whatever, that the hash rate? Does that actually proportionally reward and secure the network at the same time? And how colored coins actually is an awesome idea, but it actually throws everything, a wrench into the system. And I can explain how. Yeah, I'm curious
because again, there are lots of different. It seems like when you build on top of a blockchain that doesn't have what you're trying to do fundamentally baked into its core mechanism, that this sort of thing is kind of inevitable, is that you're trading not having to reinvent the wheel, you're not having to create your own Bitcoin or, launch your own chain and do all the mining and stuff. But in exchange for that, you get, there are disadvantages. That's this, right?
Exactly. Yeah. And I hate to use it, but you're kind of free riding if you're using these hacks. And I hate to call them hacks. They're beautiful. Counterparty was able to throw it in. But in a sense, it's not a big deal today or tomorrow, even this year. But for example, if you have a color or a financial instrument that's worth twice as much as the Bitcoin network itself, then it creates an economic incentive to create a 51% attack to double spend that, whatever that portion is. So again, it's not an issue that's today, but it's an issue that could be down the road if these instruments take off.
So the basic premise here is that it doesn't matter now, but if we build on this foundation, then we'll have problems in the future if this succeeds. And if it doesn't succeed, then it won't matter. Okay.
It sounds a bit pessimistic, but yeah, that's pretty much the gist of it.
Well, no, I'm trying to summarize because, I'm trying to understand what the basis is here. It has seemed to me from watching the Bitcoin space that in practice what happens is that as we get close to something that will be a problem or that people perceive to be a problem, and this seems like it's fairly obviously would be an obvious problem, be bogging down the network, there'd be issues, that people freak out and overreact and, start going in a lot of different directions trying to solve the problem. We've seen this with block size and other stuff. And Gavin Andresen gave a state of Bitcoin basically at the Amsterdam conference. And in that, he basically talked about how he thinks that the block size limit is going to have to go away. These problems are working themselves out. There has to be urgency because there's so much stuff to fix.
One of the solutions that could exist in the future for this would be sidechains. And again, I'm not necessarily endorsing any sidechains project, but the idea is you have this transactional currency that's pegged, and you can move back and forth in a two-way manner. You interviewed Austin and Adam about this. That is one possible solution. Again, it's farther down the road, and I've talked to Alex Mersai, who's the Chroma wallet guy, and he sees he says yes, he recognizes this incentive to attack. In fact, I had this article written about it. It came out yesterday. The analogy I use is it'd be like having Paul Blart, that rent-a-cop, standing in front of the vault. But not just standing in front of a vault, but standing in front of all the holdings of Fort Knox on a field. And sure, he might be able to catch one or two cat burglars or something like that. But if there's an organized criminal enterprise that's done the calculations, They'll figure out, hey, there's a particular color that could be double spent and it's worth the effort to do so. Again, you have to have smart criminals, but there's potentially smart criminals out there. And again, this is something that's farther down the line. It's not going to happen today, and maybe there will be solutions like you suggested.
So today on Let's Talk Bitcoin, we're joined by Tim Swanson and Stephanie Murphy. So Tim, we had planned to have you on to kind of act as a guest host, but I actually am really wanting to carry on this conversation about your status as one of the very few informed cryptocurrency skeptics who I've ever met. You're one of the few people who's actually written a book about the cryptocurrency space. Great chain of numbers. It's focused on the 2.0 wave of technologies that are coming out. And you and I first met actually while you were doing research for the book. The last time we talked, which was not too long ago, still you don't own any Bitcoin, haven't invested in anything, and generally you're not drinking the Kool-Aid. Can you kind of talk to us about what your experience has been in this space and why somehow you're able to resist where other people cannot?
My background, I was working in China the last about 5-6 years, and I had a number of friends that had been talking about Bitcoin. I built some mining machines, but didn't really think of the actual technology as something that would have any lasting power. And then I ended up having this really interesting email conversation with a guy named Vijay Boyapati, who convinced me about it about 2 years ago. Networked a lot when I moved back to the US. And I think the technology is absolutely cool. It could be, again, this groundbreaking stuff. But in practice, so far, the only apps anyone's actually made that have been used are gambling and drugs. And again, I know that's cool for some people. But in my view, having lived in a developing country, you don't go to that country and say, hey, the way you guys become wealthier is by opening up a lot of casinos and handing out opium. Those two aren't the drivers of growth. If they were, Macau and Las Vegas would be the number one economies in the world in their countries. But instead, it's New York and Shanghai.
Well, Tim, I got to jump in here and challenge you a little bit because I've been using Bitcoin for 3 years and I've never used it for either of those purposes. I mean, some of the things I have used it for are buying food, buying drinks, buying things online. Now I'm kind of joking, but I bought a lot of things that aren't drugs or gambling. Have you seen some of the other uses for Bitcoin?
Sure, definitely. And that's, I think long term, that's hopefully what will be the majority of the blockchain. But if you actually do a traffic analysis, and there's a really good paper called The Fistful of Bitcoins that came out last year, it was over 50% of the network was at one point Satoshi Dice or Prime Dice or these gambling sites, and another 5 to 10% was Silk Road. So, but
maybe maybe the sheer number of transactions, but Satoshi Dice was famous for having tons of tiny little transactions. So I don't know if it's really fair to say most of the network was Satoshi Dice.
Well, at its height, it was. And you can actually see this on the blockchain. If you go look at blockchain info / charts and you look at the transactional volumes in May 2012, it spiked and it basically doubled. And you have this gigantic presence that held for over a year before they had some real competition.
Okay, hold on. What about the survey from Zero Hedge? Have you seen that? That was done around the same time, I believe, where people actually self-reported that the most common use of Bitcoin was gifts, tips, donations, charitable purposes.
Self-reporting is an interesting distinction there, Stephanie.
You can dismiss anything self-reported, but there are people out there who do give tips and donations with Bitcoin. I mean, that was actually the other thing that I wanted to mention that I've used Bitcoin for. I think that was actually the first thing I ever used Bitcoin for was to send someone a tip online.
So let's take a step back from this for a second. It seems like at the time that you're talking about, Tim, there really wasn't much else to do with Bitcoin. If you wanted to use it for buying things, that really wasn't so available to you. There weren't many options for it. And so it seems like whenever you have this type of innovation, it always starts on the fringes. For the people who are least served by the existing options, they come in, have the most reason to use the new technology that enables whatever the heck they want to do. And then that's the thing it gets used for. But over time, that's being diluted. Stephanie, we've, kind of had this ongoing conversation about whether or not the libertarianism is kind of being sucked out of this thing over time. And it's basically the same thing, right?
Sure. So you brought up a few things there. Again, I'm not saying this is the only app or won't be the only app, but if you look at the blockchain behavior, number one, nobody likes to spend. Everyone holds. You see that meme, HODL. Everyone just wants to hold. And you see that on actual behavior. I posted an article on CoinDesk a couple weeks ago that showed how the vast majority of tokens don't move once once people have them. You have about a 10%, 15% amount that's liquid, and the rest of them are just stored forever. And people are like, oh, you know, what happens if it hits 10,000 or whatever? Even when prices were going up to 1,000, people didn't exit the system. Even if they wanted to, though, they couldn't. There's just not enough liquidity for that. So in general, the actual behavior is most people don't spend Bitcoins that have them. They hold it for speculative purposes. And those who do typically spend it on token things and on vain things. Or
Come on, Tim. Hold on a second. You're making a lot of value judgments about the way that people use their Bitcoins. I mean, what if it's normal to primarily be in savings mode? And just because people don't really exhibit that behavior with dollars, you could say they have the opposite problem and they spend too much dollars and they never save anything. And it's a cultural thing. So isn't that just a value judgment that you're making on how people spend their Bitcoins or not?
I'm sorry if it came across that way. I'm trying to actually describe the reason why they're doing it. And the reason why they're doing it is because it's a deflationary asset. And so it totally makes complete sense. I'm not trying to, bash people. It's the same thing with gold. Even though gold's been around for a while, people aren't using gold day to day, even though they technically could. And it's because it's a deflationary asset. They expect it to go up in price, or they expect it to go down in price, and so they're holding, or so on. I suspect that most of the people that are actually held, and you this article are people who are underwater in the last 3 to 6 months. So they basically bought at the peak and it's gone down. And maybe they will become more liquid as time goes by. But the actual data on the blockchain, which is public, shows that people don't spend, and those who do spend primarily spend for illicit activities. And again, I'm not saying these people should be thrown in jail or should be not condoned or whatever. I have no particular opinion on that. I'm just saying in the 5 years that it's been around.
Illicit activities? Playing a game online is an illicit activity? Really?
People ask me why are you kind of skeptical about it? Again, I think the technology is really cool, but instead of going to the places where, for example, that most use of it would be done, which would be NGOs in third world countries, we have people who sit around on Reddit all day. They're underwater scammers, basically. It's turned an entire generation of nerds into day traders. And so, there's different games and stuff like that you can play, but those activities aren't growing the economy, that aren't going to bring in new legitimate players or new legitimate customers or clients. If you want to have a new economy, you need to bring lots
players.
of
Wait, okay, your judgment's all over the place. Legitimate. Okay, if somebody gets into Bitcoin, if somebody finds out about Bitcoin because they want to play a game online, you're telling me they're not a legitimate person?
Sure, I guess that I probably should rephrase that. If you look at a developing economy and an emerging economy, you don't go up to loan sharks. You don't go up to big casino operators and say, hey, grow my economy. No, you go up to people who bring legitimate economic growth engine.
You're kind of shifting the goalpost here, I feel like. I mean, okay, first it's online gaming is illegitimate, and then it's loan sharks and casinos. I mean, I think Bitcoin games online kind of remove loan sharks and casinos from the equation, because you don't really need a casino if you can go to play a game online, right?
Well, are you talking about gambling games, or are you talking about Humble Bundle?
Well, whatever. It doesn't really matter. I mean, there's all kinds of different games online, and anyone can judge them however they want, but it's unfair to lump all games online that involve Bitcoin in with illicit and illegitimate activity and say that anyone who uses them is an illegitimate user that's not growing the economy. I disagree with that.
Yeah, sure. It's a fair point. Again, I'm equating illegitimate with entertainment. I'm not saying that they're not actually moving money. There's not actually economic activity. It's just not growing an economy because you're not bringing in actual growth segments. In order to do growth, and you hear these people say, oh, Bitcoin's going to replace these economic engines. Well, it needs to create those economic engines in Bitcoin and not just continue to move money around.
We could tell Aunt Millie stories all day, but I know some people who got interested in Bitcoin because they wanted to play Seals with Clubs, Bitcoin poker online, and now they have businesses where they use Bitcoin with their business. And it's a totally legit business, or something that you might call legit, like they're selling candy online or food or something like that. I disagree with the notion that, popularizing the use of Bitcoin through games doesn't grow the economy, because it does.
I think the argument here is that it's not GDP contributing activity, and that it's not actual fundamental economic activity. It's personal spending, and that is economic activity, but not in the value producing way that Tim is defining it here.
Why does economic activity for personal spending not produce any value? Are you talking about taxes?
No, I'm talking about if you look at broad metrics, the way that we actually measure productivity, we don't use person-to-person commerce in those measurements.
Talking about the developing world, 2/3 of the world's economy is in system D, unregulated, untaxed, off the books, person-to-person transactions. And in the same breath, you're saying that it doesn't grow the economy to have those kinds of transactions. So, I mean, I see a conflict there.
Well, again, it depends on what country you're talking about. In the country I was talking about the U.S. In the U.S., That's how we define GDP. And again, I think that Tim is probably speaking from both the U.S. and a China perspective, right? I mean,
sure. There's actually a really simple, there's something called total factor productivity. That's what economists use to measure whether or not an economy is actually basically growing. If you use the same amount of inputs and those inputs become more productive as time goes by. And you see that in China, the way those inputs become better is through education, through training, through technology. And you don't have the same thing happening with Bitcoin. In fact, because of the way miners work, there's not much you could do to make them necessarily better, except for something maybe like Sidechains and so on. So my point with the actual growth with gambling, if gambling grew economies, we would have a growing economy with Bitcoin. What's growing Bitcoin are things on the edges, like Coinbase and Circle are these great, wonderful, easy to use tools, but it defeats the whole purpose of having a blockchain because they're centralized, trust me, silos.
So what about things like 37 coins or like some of the technologies that are making Bitcoin easier to use on feature phones?
Sure, those are great, and I'm really glad people are making things like that. I've talked to what's his name, Marshall from QuickCoin. I think that's a pretty cool idea too. HTML5, Facebook wallet, but again, you need to have Bitcoins in order to use them. People don't want to spend Bitcoins; they hold them, and that's totally fine. That that makes sense if it's a deflationary currency and so on. But my point is if you're going to try and grow this economy, you need to take that into account when building a business model. And again, since people like to hold and save, then maybe figure out some ways to create derivatives, create some way to create interest off of that, figure out how to make a loan with those. And unfortunately, that takes a lot of time. It takes a lot of compliance. It takes legal frameworks and attorneys to hire. Obviously, I'm going to get a lot of hate mail for saying that, but that's the truth. That's how people treat Bitcoins today. So if that's how people treat them, and if you're going to do a consumer behavior study, then you're going to say, okay, I'm going to make a business oriented towards that. And people can say, oh, Tim, you're wrong about all the gambling around what grows and stuff like that. But you can disagree with that all you want. But if you want to actually see how people use it and why they use it, they hold it as a store of value. If they hold it as a store of value, you should build a business around that particular thesis.
CryptoKit is the world's first Chrome browser Bitcoin wallet. It's the easiest, fastest Bitcoin wallet payment system. With a simple one-click install, it takes just seconds to get your wallet set up. And because CryptoKit finds the address and payment for you, there's no more fussing around or tab switching. CryptoKit is more than just a wallet. It comes with a preloaded PGP encrypted social network, news feeds from Reddit and Google, and up-to-date charts from exchanges. Finally, CryptoKit Directory allows you to make two-click payments with any of the BitPay merchants. Once you install CryptoKit, you won't need anything else. For more information or to download CryptoKit, visit CryptoKit.com.
Hi, listener. Here at Let's Talk Bitcoin, we're building a global network of correspondents able to contribute on-the-ground perspective when cryptocurrency-related information comes across their filters. If you'd like to join our global conversation, send an email with your name and geographic or cultural niche to apply@letstalkbitcoin.com. Just like Bitcoin, the only barrier to entry is your time and good work. Thanks for listening.
What do you think of Dogecoin? With its PR and very inflationary, and I mean, like the incentives aren't to hold that. Do you have greater hopes for that because of the fundamentals?
So I had another CoinDesk article about that a week ago, and again, I like Jackson. I've met with him several times. I think he's a great guy. He's a marketing guru, and I think that Dogecoin did bring a whole lot of new demographics, but I think it'll be dead in about 4 months. The way this is happening is you see this with the hash rate. Network hash rate, if people are unfamiliar with this, basically the strength that shows the strength of the security of your network. At least one quantifiable way of security. There's another way of quality, which would be how dispersed and decentralized it is. But for the purposes of this, every 2 months, the network hash rate in Dogecoin has been decreasing by 20 to 30%. It corresponds exactly with the block rate rewards having. block rate rewards halving is basically, this is programmed into almost all cryptocurrencies. In a certain amount of time, the block reward will go from 50 to 25 or 25 to 12.5, which would be Bitcoin. And these block rewards are basically the subsidy. It's basically the way to bribe miners to stay on board. It's the big income. And if you look at, for example, with Bitcoin, over 99% of a miner's income comes from block rewards. They only receive about 0.31% from actual transactions. So when people say, oh, I don't want to pay transaction fees, well, nobody likes spending transaction fees, and so nobody does. And same thing with Dogecoin. Dogecoin's transactional volume today is at the same level it was the very first week when it was launched. It basically did this gigantic parabola. So it went up in the sky, it came back down. The network hash rate's been going down every 2 months by 20 or 30%. I'm not trying to be mean to Dogecoin or those devs that that worked hard, but what's going to end up happening is they're going to give away, essentially because this was programmed from the beginning, they're going to give away all their subsidies in the first years to bribe the network operators, the miners, the labor force. And so the labor force goes to somewhere that's more profitable to mine. So you see this happen, they go to Litecoin or some other script-based coin. And so even though they did create this cool meme and something like my girlfriend likes, she's like, oh, there's actually women at these meetups. And I had a meeting with this banking executive about a month ago, and he's like, Tim, what's the biggest difference between Dogecoin and the rest? I was like, well, women are there. He's like, oh, it's the wingman coin. It's there to be goofy in front of all these other women and, at the bar and make you look good and stuff like that. Yeah, I think it's a pretty good analogy, and it's going to need a wingman to survive. That's the gist of my article. I think it's cool, but again, going back to tips don't grow an economy necessarily either. There's really no academic literature that shows how tips actually grow an economy. They acts as a faucet. It acts as a way to distribute tokens, and that's fine if you want to, have fun and do reputations and content. Maybe that's a way to do experiments. But to actually grow an economy, you need to create an actual enterprise that creates economic growth. And tipping doesn't do that. You don't go to like Chile. You don't go to China and say, hey, China, your problem is you guys don't tip enough, so start tipping. That's not how it works. And so if Dogecoin, well,
what about micropayments? I mean, what about the experiment with the Chicago Sun-Times where they did the bit wall and people had to pay to get their articles or whatever, and people sent 25 cents, which is pretty much impossible with a credit card or PayPal, right?
Sure, it's impossible to do it with today, but this is what Gavin Andresen pointed out at Amsterdam. He's like, if Bitcoin becomes popular, you're going to have a transaction fee that costs more than whatever that costs. It's going to price out the poor, basically. The transaction fee will increase. If Doge ever became popular, the transaction fee that ever came to exist, if they had one, would be higher than a cup of coffee or something like that.
Unless that problem is solved by decreasing the need for higher transaction fees by increasing the block limit or whatever, right? That problem could be solved. It's not going to be a problem forever.
There's two things. So yeah, you're right. With block size, that didn't exist. Like if you look back at the very beginning, Satoshi, there was no block size, there was no transaction fee, and both were added for different purposes, but for generally speaking, to limit spam. And again, nobody likes to pay fees. But in order to incentivize miners to actually do something aside from to do what they're supposed to do, which is provide this labor, provide the security and transactional volume, you need to give them something. There is no free, and that's one of the things I think that people should stop saying with Bitcoin is Bitcoin's actually really expensive. If you actually look at the transactional cost, today it's about $35 a transaction if you do transactions divided by how much miners are paid. And that's extremely, the way that's actually paid out is through token dilution. Any holder of Bitcoin actually pays an inflation tax every 10 minutes or 8 minutes.
Where did you get that number from?
Yeah, Blockchain Info has a chart. It shows you every day about how much it's going to cost. And all you do is you just take the transactional volume divided by how much miners are essentially paid.
It's not the cost to a single miner. It's the aggregate cost of the whole amount of money being put into mining, essentially through electricity and equipment and other things like that, relative to the amount of transactions that are going through. So the network is super, super redundant, very, very overcompensating. And because of that, there's a lot of wasted money going in. But that's not a cost that's carried by anybody outside of the miners.
Yes and no. Again, the miners are paid every 10 minutes through seigniorage, right? And that seigniorage would be this subsidy is diluted to everyone's shares in a sense that if there's 1,000 shares today, in the next 10 minutes, be 1,010.
But Tim, that depends on how you're defining dilution, because I think a lot of people look at the Bitcoin money supply like myself, which is to say that there are 21 million of them. Currently, there aren't 21 million of them out, But the number that's relevant is that 21 million. And the seniorage you're talking about is just moving us further towards that point. So yes, it's dilution, but it's scheduled, planned dilution that everybody's aware of.
Sure, no, you're right. You're right. Everyone understands in the beginning, hey, this is going to happen every 10 minutes. Like we have inflation of 11%. Like the money supply is going to expand 11% this year. It's paid for by everyone in that sense. It's a tax on everyone. And I'm not necessarily to disparage this versus quantitative easing. I'm not saying I'm defending quantitative easing, but I'm saying if you actually look at the data, that's exactly what's happening.
But you said a few minutes ago that Bitcoin is deflationary. So which one is it? Is it inflationary or deflationary?
It's inelastic money supply. There's no way to change it. And in the long run, it's deflationary. In the short run, in the first 10 years, it's actually pretty inflationary. But after the 10 years, after you subsidization disappears, it becomes quite deflationary. But right now, in the bootstrap phase, it's highly inflationary. And actually, all currencies are. It's not just Bitcoin. You know, Dogecoin was even more, Litecoin, and so on. You raise a really good point, Adam. So you have this thing in economics: marginal cost equals marginal value. So like the dollar in your pocket, it doesn't cost $1 to make that. The face value of that is going to be significantly higher than whatever it costs. So that's the way it works with state seniorage systems. In private seniorage systems like you have with cryptocurrencies, you have in the long run marginal value equals marginal cost. And Satoshi pointed this out himself in the original FAQ. He said that the value of the token will essentially equal the cost of extracting the rent. So essentially energy equals whatever the value of the token is. So if you have $1,000 token, $1,000 worth of energy will be burned to create that token or to secure that token, and so on. So like it'd be a $10,000 token, you have $10,000 worth of energy or capital being burned on the other end. So the reason this is important is because miners, again, are being paid the subsidy, and they're going to have to start dumping, or they do dump, and you see this actually with short-term velocity, if you will, of the tokens, is that they sell these on the market. And so every day there's, at least at the price today, it's like $2 million worth of tokens being dumped on the market. You have to do this. They can't just hold on to it. It's not like free to them because they have the real cost to pay. The only people really right now who are benefiting from the Bitcoin prices and so on are TSMC, which is an ASIC producer, energy companies, and then really, really, really large farms. So on the mining side of things, those are people who are benefiting from it. Everyone else, these marginal players, are usually operating in the loss or operating losses. And I saw this firsthand in China when I was building these machines, and people basically mine right now today because they believe it's going to appreciate in value later on. And they're in fact, they're over-securing the net deadweight loss after the 21%. So I'm not saying this is why I'm skeptical of the situation. I'm just trying to explain the token dilution, and without that subsidy, they wouldn't be securing the network in the first place.
But don't you think that over time, like if you're saying that $35 per transaction is like the approximate amount that's been poured into the network, don't you think that over time that will tend toward more efficiency, if for no other reason than people will realize they're operating at a loss and they'll say, well, we got to do something differently if they're miners?
Yes, it's a really good question. So at least 3 exceptions to the rule. And so an economically rational miner, someone who's actually doing this profit loss, so like, okay, I'm going to stop operating if I'm not making as much money as it costs, right? But there's exceptions to this. There are hobbyists who are just having fun and researchers trying to figure out how the system works. And then there's botnet operators. Botnet operators don't really exist anymore with Bitcoin. They've gone on to other CPU-based cryptocurrencies. But for a while, there's a really good paper. I could send it to you if you want. It's basically monetizing stolen electricity, monetizing Bitcoin cycles. And what you had is basically you have legitimate players out there who want to mine, and then you have we would call illegitimate players, people who operate mining these botnets. And what happens with botnets is it squeezes out marginal players. It artificially inflates the difficulty rating. And as a result, when players want to get back in after botnets have gone, the difficulty rating is extremely high, and they can't play the game anymore. And in addition, botnet operators externalize the costs of, for example, of electricity, of hard drives, of CPUs, because of the real depreciating capital goods right there that have now been worn out, and somebody has to pay that cost. So yeah, in the long run, sure, I'm sure it'll all just be ASIC centralized somewhere where the cheapest energy is. In fact, I make that argument in another paper. As far as the $35, it actually will go up. Transactional volume could cost more, and we saw this earlier. Like when you had a price peak of 1,000 or whatever, the cost was like $75. So it kind of, I'm not saying it will. There is a correlation or necessarily causation, but it typically does follow whatever the token value is. For one reason, for the one particular reason that people only use Bitcoins primarily during a bull run or during a frequent movement, and then it stays the same. That's why for like 6 months, since December, basically there's been no added transactional volume on the actual blockchain. There's stuff on the edges. On the actual blockchain itself, it hasn't moved. There's about 60,000 transactions a day. When I first got into writing about this stuff 6 months ago, the actual amount of merchants was about 20,000, and now we're over 60,000. So you've had basically a tripling of merchants, yet no new transactional volume, and that's because people like to hold the token, and that's totally fine. That's their own decision, and they see it as a deflationary good. But again, if you want people to spend it and you want to be able to pay miners through transaction fees, you need to do something, and you need to incentivize that. In actual use case, nobody likes to pay fees, and nobody wants to pay miners that way.
The conversation to this point has largely been about Bitcoin. I think that it's an interesting part about cryptocurrency because, again, you have all of these other options out there, and they might not have the network effect yet, but they're doing kind of interesting things. So as you're speaking about this, I'm sitting here thinking, this sounds a lot like what Dan Larimer is working on with delegated proof of stake. That's what he talks about too. He talks about the inflation of the money supply through mining and stuff like that. And again, it's just about how you look at it. But his solution, are you familiar with it?
Sure, yeah, I've seen his paper. I've actually linked it, I think, in one footnote.
The point is that there's no inflation in it. It's just a deflationary environment. I don't believe that there are much in the way of transaction fees, but it's because the people who are actually signing blocks, which is what miners do basically, they sign blocks.
Like that responsibility is delegated to smaller groups of people than the entire network. Is that right?
Right. Yeah. With the idea being that there's still accountability in the system because it's completely transparent. And so if one of the delegates does something wrong, then unless all of them are doing it wrong at once, then all of the others, plus the entire network rationalizing the thing, catches the bad actor, kicks them out immediately, and they lose whatever pay they were going to be owed for the work that they had been doing. It's a totally automated position, but it's a partial centralization. It's not a federated system, but at the same time, you get rid of all of the monetary inflation that you have with that. So I mean, like, Tim, does that sort of thing, is that what you're looking for in cryptocurrency? Or if that's not a good example, is there a good one you can think of? Someone who's doing it right?
I think alts are a great way to experiment with this stuff. Yeah, so proof of stake is a pretty cool idea, and in general, but unfortunately, almost all proof of stakes that have existed to this point have failed in some manner, and so they've ended up becoming centralized. Was it Peercoin? They basically have to have centralized checkoffs by the actual dev team for each block, so it kind of defeats the whole purpose of the actual decentralization. So I mean, there's different ways you can do it, and yeah, maybe Daniel's figured out one way to do another way of consensus, a trustless consensus. And I wish him the best of luck. There's another project, I think it's Stephen Green, who's come up with a way to fork Bitcoin to make it proof of stake. The problem with any trying to tinker with Bitcoin's actual protocol right now is trying to get the miners to buy into it. They've already got a cost curve on how much it's going to take to recoup whatever their capital costs are, and they're only going to cycle code that's profitable to them. They're only going to hash stuff that's profitable to them. So proof of stake is not profitable to any miner because there's no seniority involved. So essentially, these things will have to be done on these other ledgers, and I wish them the best of luck. If the listener would like to check out two different experiments, there's one called Stablecoin and one called GrowthCoin. GrowthCoin is an idea proposed by Robert Sams. He's one of the guys I mentioned at the very beginning. He came up with this idea about 5 months ago, and I'm not sure if he's actually going to implement the code, but the idea is basically you have some kind of realignment of the token every so often. And you see this best actually in Stablecoin. And Stablecoin is a project that was a finalist for a blockchain award last month. Basically, it was a paper written by Ferdinando Armatano, and he's come up with this idea of every day your wallet is rebased based on how many transactions the whole network had. So say you had 100 tokens in your wallet and there was like 2% transactional volume network wide, then you had 102. Basically, every day you had a rebasing of your actual tokens. And obviously people who want a deflationary currency would never use it because they like, oh no, this is just inflation. Well, it's not trying to be either inflation or deflation. It's supposed to be disflation. It's just a rebasement to use deflation. Disflation. It's to get people to actually use the token for transactions. The issue with Bitcoin, though, is in practice and really in theory, it can only really be used as a store of value or as a medium of exchange. And people don't want to use it as a medium of exchange in practice because it's volatile. and because it costs money to actually use it. It's wonderful for merchants. Merchants have every reason to use it because it doesn't cost them anything to accept it. But you as a user have to pay a fee. It's like if you want to go to Walmart, you don't want to have to pay any. But with Bitcoin, you're like, oh, you actually have to pay a fee if you actually want to use it. So with stablecoin and growth coin, the idea is you have this rebasement, which kind of pays for itself. They haven't worked out the whole mechanics. It's still like in the drawing board. But these are two projects that maybe listeners would be interested in trying to implement. I know I could introduce them to Ferdinando or Robert. They're always interested in talking to people.
Hey there, LTB listeners. In the last 6 months, we've morphed from the Let's Talk Bitcoin show into a full network of cryptocurrency-related content. You might have noticed your podcast feed getting a little crowded, and by now you probably have a good idea of which shows you most enjoy. To subscribe to individual shows, head over to letstalkbitcoin.com/shows, where you can build your own custom blend, subscribe to individual shows, and also grab our full written article feed, which is your ticket to a wide variety of Bitcoin stories and opinions. Oh, and one more thing. If you're into Apple devices, check the App Store for Let's Talk Bitcoin to download our free show player and virtual magazine, optimized for iPhone 5. Android versions will include wallet functionality, and currently we're in the planning phases on that. If you like what we're doing, please rate, review, and share. Thanks for listening. Back to the show.
So, Tim, you wrote, I guess was it the first book on the kind of cryptocurrency 2.0 stuff, the counterparties and mastercoins and, the NXTs and the various other projects that are kind of out there in space? Was this the first publication on it?
Actually, it's funny. It was, and it wasn't my goal to do that. I just basically put together a bunch of notes. I consider myself a student learning from the community. I have so many thanks to give to the community. Criticism I've had so far isn't towards any one particular person or one particular entity or anything like that. And these are just growing pains, some challenges, and that happens in any economy. So, but yeah, with my book, I interviewed about 4 dozen different people, including yourself. You actually wrote a very kind foreword for me. You hear about these different 2.0 systems, and there wasn't one particular place you could go that had it all laid out. And I made an effort to try and talk to each of the lead developers of these projects, one-on-one or on Skype or by email or over the phone. And then I compiled, their interviews as well as people who do investments, entrepreneurs, and they all have really cool ideas. And I certainly wish them all the best of luck. And, if you want, I could go into some of the interesting ideas if you'd like.
I'd be curious again, this is a big, wide, deep space right now, and it's really disconnected. Some people have the ability to spend all their time absorbing that information, but certainly not everybody. So yeah, I'd love your perspective on the space.
I guess some of us on the outside have heard about smart contracts for a couple of years. And I remember actually reading some of Nick Szabo's works back in a few years ago before I equated it with this cryptocurrency space. He's basically the godfather of all this stuff, or the intellectual father to this movement. And I don't want to say movement, but this idea of creating trustless asset exchange, trustless asset management. And so smart contracts, for just in short, is this computer code that executes itself. It's a contract that's able to verify and execute the terms of the contract. That's a cool idea, and it could do this in a trustless manner. Now, obviously, you're going to have hurdles with legal issues. Do you have a meeting of the minds? Are you indemnified on the chain, and so on? But for strict purposes, just for this theoretical, if you could create a bilateral mechanism for exchanging assets, so you don't necessarily need to exit a system. So, like, for example, one of the common complaints with Bitcoin is, most merchants just immediately convert their Bitcoins to fiat, and that's pretty much true. But if there was a way for them to actually keep that and create a closed system to where they pay their suppliers, they pay their employees in Bitcoin, the same thing could happen with smart contracts. Maybe they could trade titles of their houses and titles of their cars and so on. So it's a pretty cool idea. It could definitely help out people in the developing world. Not so much people in the developed world, because we already have a pretty good system for the most part. People will argue, and I'm sure I'll get hate mail for that. But in the developing world, for example, with China, You have a lot of marginalized players, these migrant workers, several 100 million of these migrant workers who move to cities, and their contracts are completely ignored. There's no, I could actually give you numbers with that a little bit later, but the idea is this: is you could empower people who were underbanked or underprivileged. Although in practice, it probably won't take place in China because of the way the party works there. But in theory, this would be a pretty cool thing to try out, maybe like in Honduras or Guatemala, along with a DAO or a decentralized autonomous corporation or something like that. Obviously, these things are still, on the in coding beta stages, and nobody's actually made a DAO for all I know. But I see there's obviously a lot of potential with autonomous agents. I know Mike Kearns talked about this quite a bit. So the listener, if they're interested in DAOs, it's a decentralized autonomous organizations, and there's no one concise definition. I cobbled together pretty much what Vitalik Buterin defines it as this entity that lives on the chain. The actions can only change with a certain amount of votes. Basically, they're like a multi-sig entity, and they could pay shares, they could pay payroll. And I actually quote you extensively too in that chapter. You have a pretty cool idea with decentralized autonomous consensus platforms. I believe that's actually what you use. But
I guess I need to publish that at some point.
It's a good paper. I liked it. And I know Mike Kern has his own view, and he actually says, oh, my view is different than everyone else's. And it is. Autonomous agents, the actual term goes back about 3 years. If you look on the wiki, the Bitcoin wiki, it goes back to Amazon Web Services, basically creating a program that pays itself and pays labor and can replicate itself on an Amazon Web, shard. So that way, if it succeeds, it could grow on the system, and if it doesn't do well, then it'll shrink. But see, the problem with AWS is it's centralized. I don't think that's necessarily a problem, but purists will say, oh, it's a problem. The idea with decentralized autonomous is it moves it to where it's on some kind of decentralized chain, and it supposedly can replace all the administrative organs of an organization. And so this could help, especially with NGOs, with their overhead. Instead of paying 25% of their donations towards administrators, they could pay 100% to people in the field actually helping out. So yeah, that's a pretty cool idea. Again, though, I need to caution listeners about the potential versus what probably will happen. For example, in China, this is the way I tell people. With property rights in China, most people are given a 70-year lease. That's what you think you have by the state. But in practice, you only have like a 40 to 50-year lease, and that land can be anytime it wants by people with good guanxi. And there's 4 million rural Chinese who are evicted every year from the land. The reason they're evicted from the land is because local governments generate about 70% of their annual income from land sales. These are real numbers. I could give you citation. And so you end up having this kind of push towards these urban areas. So you have about 120 to 150 million of these migrant workers who end up there who've just been evicted, and they don't have any skills, and they don't have any way to have real justice, if you will. And so, the idea is DAOs can help with the payroll, it could help with the contracts, and it could help them maybe with escrows or even arbitration. Now, obviously, all these things are cool in theory and maybe could happen, but unlikely would happen in China just because of the way the party apparatus works. So if I was listening to this and you're thinking of ways to put this, I would just go to smaller countries or countries with better rule of law. So maybe start somewhere in a poor area of the U.S. where there's a lot more underbanked or underprivileged people. I don't even what do you want to define that particular segment as? Or go to like Honduras where there's all these startup cities projects and stuff like that. So yeah, DAOs have this cool possibility of being able to trustlessly rearrange or manage assets in a relatively transparent manner. Obviously, there's still weaknesses on the edges. And actually, I'd like to seek into kind of what you were talking about, your consensus platform. Would you like to mention a little bit about how you envision this space growing?
It's sort of funny. I write all these papers and I don't wind up publishing a lot of them because they're not really, they tend to be long and not suitable for publishing, really. That one, in a nutshell, you can have an outcome that you want to achieve. You don't necessarily have to know how to achieve it. You then can create a cryptocurrency. By buying into that crypto token, they imbue the outcome with value. Then once a certain threshold has passed, like a Kickstarter campaign's threshold, then the entity essentially becomes able to act on its own at the direction of its members. So that token that people get back then is used as voice within the organization, that, you don't spend your voice, you exercise your voice, essentially. There are a variety of other things. It's a fairly complicated issue, but the idea is that if you take a big pile of money and you set it aside with a sticker on it that says this money can only be given to or retrieved or released or whatever to the person who makes this outcome a reality, then with a deflationary currency, especially over time, that will get to be a more and more and more and more attractive thing until the economics make sense for it to actually happen. And so essentially people are committing themselves to fund an outcome, not committing themselves to fund a project that might not succeed.
Yeah, it's really clever. I mean, I have to hand it to you. I mean, that's why I put it in, I think it was chapter 4 is where it's at. So, and again, going back to those skeptical comments I had at the very beginning, I think that there's a lot of potential in this particular space, especially if you go to the NGO segment. And the problem in practice, though, is NGOs don't pay. So, again, listeners, if you're expecting me to say how this won't work, I'm not going to say that. I'm just going to say that there's a lot of cool potential with this particular space, and you need to create incentives for people to actually develop this code. I suspect people will create code for this just because they want to change the world or whatever, but that's not necessarily even to say sustainable in the long run either. But
change the world or whatever. I love that.
yeah, something simple like that, right? So,
yeah. So you talked about stablecoin and growth coin. Those are two experiments that I was not familiar with. Are there any other things like that are just like super niche? Because again, the cryptocurrency space is so big that even people who spend all their time paying attention to it, you just can't be looking everywhere.
There's another one called Fluttercoin, but that's pretty much DOA. The idea is proof of transaction, and it doesn't work in practice. It broke apart, but the idea is pretty cool. You basically get paid to transact and incentivize people to actually spend. So maybe this is a way to actually do tipping in practice, so that way you don't have to rely on silos. Like the reason why Doge is really popular, or these tip bots, is they're centralized, so they're really fast and so on. But it defeats the whole purpose of having a blockchain. So maybe Fluttercoin could eventually, somebody could take that and evolve it to something that could still work in a decentralized manner. I should point out, I'm pretty open to altcoins. I know you'll have a group of people in Bitcoin who hate them. They think that they destroy it. But look, there's two economic reasons for why altcoins will always exist. Number one, nobody gets paid to do anything to develop for Bitcoin code. So if you have a unique skill set, if you could actually build a blockchain, which only very few people can, you want to get paid for that. And I know that sounds maybe sounds crass. I don't think it does. You have bills to pay. You have a family to feed. So you need to be paid. So it creates an incentive to make an alt that will actually pay you. So that's number one reason. The second reason is with ASICs. ASICs are depreciating capital goods, so they only have like a 4 to 6 month window for which they're actually profitable before it's no longer capable of hashing and making money. And so you need to turn those capital goods into something that's still profitable. So you create an alt or you turn it towards another alt. And these alts, as a result, even though they started as pump and dumps and these scams and so on, they actually come out to be this. The analogy people are using now is a Cambrian explosion of sauce. You have this new mixture of trials and tribulations. I know that X11 is an example of this. X11 is a different type of proof of work. Actually, it's 11 different types of difficulty setting that are baked into the protocol, and Darkcoin was one of the first to implement this. I'm not necessarily endorsing Darkcoin, by the way, guys, but the idea is they're trying out ways to prevent ASICs from becoming the actual way to monetize these cycles. And I'm not against ASICs. I'm just saying what happens with ASICs is once ASICs become commoditized, the competitive advantage is energy. So everyone will essentially go to where the cheapest energy is, which creates centralization and stuff like that. But the idea is with these alts that we've talked about, it gives you a chance to actually screw up on a chain and not destroy $5 to $10 billion worth of assets. I don't want people to have a takeaway that, hey, I'm bashing Bitcoin core devs. I think they work really hard, they're underappreciated, and the market doesn't value them, even though everyone's free riding off of their use. So basically you have socialized labor and privatized gains with these guys. And but they have to be cautious when they develop code, because they don't want to destroy billions of dollars worth of a transactional currency or store of value, or however you want to define it. And so So these alts, it gives you a chance of these alt chains to not actually, blow up or bankrupt an economy or a big economy. It's like $5 million worth of stuff. And I hate to even say $5 million is not worth much. But if Dogecoin blows up, for example, that's only $32 million worth of money supply, almost 3 orders of magnitude less than Bitcoin. So you won't have people jumping off buildings. Well, at least hopefully you won't have people jumping off buildings.
Thanks for listening to episode 116 of Let's Talk Bitcoin. Content for this episode was provided by Tim Swanson, Stephanie Murphy, and Adam B. Levine. This episode was edited by Denise Levine and Adam Levine. Music for this episode was provided by Jared Rubens and Gertie Beats. Any questions or comments? Email Adam at letstalkbitcoin.com. Have a good one.